Jignanshu. Great to have you on ET now once again. Jignanshu, a very strong operational update once again for Titan, but I guess the market was already anticipating that and it's well in the price. How are you reading into the takeaways from Titan?
Thank you so much, Aisha. Always a pleasure to be here. Yes, I think strong update, very impressive despite the gold prices cooling off materially to immediately drive buyer growth to high double digits. I think that is the biggest positive from the business update that Titan released yesterday. The expectation of the market was that while the gold prices might cool off, buyer recovery will take time. Apparently not from what we have seen updates across the industry, which just tells you the strength of the franchise, the brand, and what the businesses have built. Just one small point, if I were to think of the consumer side, it might be because the higher gold price means higher outlay, and hence you go to a brand to trust the quality of the gold that you're getting versus going to unorganized dwellers. That might be driving sustained buyer growth despite immediately with sort of gold prices falling. That trust is the replacement for purity.
Jignanshu, as gold prices cool off, do you see a trend where more jewelry will be sold as against bullion sales, which we saw in the last few quarters?
Yes, I would expect that trend to reverse. At least in the last 2 quarters, gold coins and bullion were a very high share of the business. Though Titan always reports its sales X of bullion and X of coins to give a true picture of its jewelry business. Because the margins are driven by the jewelry business. So that mix change, especially coins, would support margins for Titan, as would in the short term the customs duty increase because they've paid customs duty on their inventory. So they've not paid on the inventory, but they can now collect it from the consumers.
How is it that you're reading into Trent, Jignanshu? Because while the revenue growth seems a little below estimate, and, they've added only one Westside store as opposed to 19 Zudio stores. Does it seem like, there's a strategic thought behind that this time?
So I think in general, the Trent results were a little disappointing versus our expectations and versus market expectations. Revenue growth, we thought would be 200 or 200 to 300 bips higher than what it came in at around 19%. And we think the market was also penciling in higher growth. On the store expansion side, I would say, given the recent guidance by the management in the AGM, the +1 Westside store is even more disappointing than it would have been otherwise. They did around 50 last year, but one part and expectation was that they will retain this growth over this year as well. So we think a more disappointment ahead for Trent, especially when we look at the growth that some of its value peers are giving, whether V-Mart or Style Bazaar or V2 Retail were also given business updates. The strategy remains the same, but we think the industry and the market is not as conducive to Trent. So we do like its overall strategy and execution, but in the near term, we are not sure if the urban consumption landscape is positive for a recovery in Trent's price.
Jignanshu, in your last report, you were more bullish on Westside, and it read as, is Westside the new Zudio? Are you going to recalibrate those numbers after the kind of a quarterly update that has come in?
So we are looking at a company from a much longer horizon. And I think one quarterly update is not meaningful enough to completely change the view. What we wanted to say from the note was over the last 2 years, 95% of investor interest in Trent has been only about Zudio. And investors have been ignoring the amount of impact Westside continues to have on the Trent financials and possibly will have a higher share of revenue in the future than what most folks are pricing in. Because the company sees much better growth potential there. It is the premiumization story, and it is the space in the industry where the competitive intensity for Trent is lower than what it is for Zudio. Because Zudio's success has spawned a lot of copycats. That's not true for Westside right now. So we felt that investor interest or focus should be on evaluating Westside as much as it has been on Zudio.
I was just looking at the numbers from Jubilant Foodworks, Jignanshu, and, before you, another fundamental expert was joining in, and he said that the best way to play QSR is via Zomato and a Swiggy.
Yes, I think we've heard that argument in the past as well. In the long run, typically brands outlast platforms because consumers keep coming back for brands. In the case of QSRs, however, what has happened in our view is the demand environment has shifted towards more variety, and that has led to better growth prospects for food delivery platforms for the last few quarters. The only challenge there is you have to play. I think the fortunes of Zomato and Swiggy are decided by quick commerce rather than by food delivery today. So if you want to play food as a sector, QSRs are the only pure play option possible.
Yeah, I think it's just a very narrow pool of the listed universe, and that doesn't quite capture the way India consumes. Maybe that is the problem with the listed QSR space. But that discussion for another time. Jignanshu, thank you so much for your time today. Good to speak with you.
Happy to join anytime. Thank you so much, guys. Thank you.